Welcome to the Engineer Real Estate Investor Show. My name is Junius Williams IV. Every show, we will talk to engineers that are looking to or have become commercial real estate investors. Since I became a commercial investor 2 years ago, I've probably met hundreds of engineers that invest as well. I think with our background of high-level math, solving complex problems, and our love of construction and buildings, the engineer is uniquely prepared to be the best real estate investor. My name is Junius Williams IV. I graduated from the University of Houston with a civil engineering degree. I returned to U of H to receive my MBA with a focus in real estate. I worked for 5 years as an engineering consultant to real estate developers. For the last 5 years, I've worked on the development side of the real estate industry. And earlier this year, we closed on a 72-unit multifamily syndication. This is episode number 1 of the Engineer Real Estate Investor Show. Today we have our very first guest. His name is Windon Jr. I found that he was a fitting guest as the idea for the show really came from our conversations about being engineers and transitioning into the commercial real estate world. Ron is a graduate from Louisiana State University, otherwise known as LSU. He studied mechanical engineering there. He's worked for multiple multinational oil and gas companies over the course of his 20-year career. Currently, he manages a team of professionals analyzing and reporting the performance of onshore oil and gas facilities. His annual budget is $300 million, which is just mind-blowing to someone like me. 5 years ago, he became a real estate investor. His original goal was to purchase 10 single-family houses, and he's accomplished that goal. He has 7 houses in Houston, 2 in Nashville, and 1 in Austin. About 7 months ago, he decided to switch tracks and started investing passively in multifamily. In just 7 months, he's a limited partner in over 1,000 units across multiple markets in Texas and some markets outside of Texas, which is really incredible growth. It speaks to how quickly you can scale in multifamily and be in different markets in a very, very short time. So just to give kind of an overview on why I'm doing this in the first place, it really started from a friend of mine that's kind of like a mentor. His name is Dr. Eric Tate, and he has a website called The Physician's Road, which basically helps physicians, doctors, MDs that are interested in investing in items outside of Wall Street, like outside of stocks and bonds, or investing with, like, say, their financial advisor, investing in real estate, investing in, I mean, he has deals that are like buying a coffee farm in Argentina, coffee, I guess, like a farm that sells coffee beans to Starbucks. He's investing in like blockchain technology. I think he has like a fund now that he's helping doctors invest in, that will invest in like tech startups or other type of startups. And I kind of looked at what he was doing and Googled like physician investing. And there are like hundreds of websites to help physicians invest and physicians to like set themselves up financially. And then I Googled stuff for engineers to invest, Googled engineers to set themselves up financially, and there was like virtually nothing. And I was like, wow, that seems like that seemed very odd to me. You know, engineers can be high income earners just like doctors. Why isn't there anything set up for us to invest in real estate or to invest in, you know, other income opportunities? And I thought, well, maybe it's because a podcast or interview thing based on engineers interviewing other engineers probably wouldn't be that interesting. But we're gonna do our best. You know, I've met like tons of real estate investors, and a lot of them are engineers. Like, engineers tend to understand finance. We tend to understand numbers. We understand buildings. We understand construction, and real estate really just combines both things that I think we all really understand. But we may do it for an oil and gas company, or we do it for a development company, or we work for an engineering company. But I think engineers are uniquely set up to be real estate investors. And I would think that Ron would agree with that. Another reason why is I think engineers we're not like big on publicity. We're not big on like necessarily letting people know what it is that we're doing. I think we're naturally low key and we kind of keep to ourselves. And, we're just happy to do our job and go to work. And, I may not have to share with you what I'm doing, but I think we almost may hold ourselves back where we could build a big community of people, hey, I did this, I did that, and sharing ideas. It'll all push ourselves forward. So that's why I created this. And I'm happy to have Ron as our first guest. Ron was like kind of the impetus. We've been meeting and having conversations for the last couple months. And I was like, man, we should do something to be able to share that with other folks with similar backgrounds that didn't know where to start or how to start or who to talk to. And the unique thing I think about Eric's website and the physician website that he has is that he is a physician, so he can talk the physician language, and he can talk about going through medical school, and a lot of doctors that come out with a lot of student loan debt or however they finance their education. So he can speak to that, and he can speak to working as a physician and all of the changes in healthcare and all that stuff. And he can say, well, I've invested in real estate, invested in these other things, and I was successful. And I've created this, or he has created this platform where he can get other physicians to invest with him. So that is that's the full story of why we're doing this today. So Ron, just to kind of get started here on kind of the interview, right out of the gate, like what made you choose engineering as a degree? Like what made you choose engineering to begin with?
That's a good question. And sometimes I still ask myself that question.
Absolutely.
It's interesting because growing up, one of the things I gravitated towards was art, but not necessarily art from a traditional artist perspective, but it was more so from a design perspective. I always had an affinity for automobiles and cars and exotic vehicles, and so I would always draw them. Right, I would have like these circle templates and shape templates, and I would be so precise with drawing the wheels and the body of the vehicle and coming up with unique designs. I remember being under 10 years old, and I would even design buildings, right, just from the outside, right, just in terms of what it looked like. Yep. And even to this day, whenever I travel to any city, I'm always curious around downtown and what the skyline looks like and how many buildings.
Around, like,
right, exactly, right.
I like this, I like that. Yep.
Exactly right. Is it concrete? Is it glass? Does it have a unique shape to it? Is it angular and all that kind of stuff? And so I was always interested in that. Now, every time I went to people's houses and visited family, I would always ask, "Hey, do you have paper and a pencil and a ruler?" And I would just kind of sit to the side and start drawing things like that. And I think, combined with that interest, being good in math and science in high school, and
Yep.
just talking to different people and counselors and things like that, it just seemed like the natural direction to go was into engineering.
Yeah, that's funny that you said that, because when I was 10 years old or 11 years old, I would actually draw like cities and draw roads and freeways. So I would draw, the stuff that the cars work on, or that drive on, or that operate the road, as opposed to, and maybe that's why I'm a civil engineer and you're a mechanical engineer, because you drew like the cars and all the engines and all this other stuff. Mechanical engineers are a little smarter than civil engineers. So
No.
all the confusing stuff, all the confusing statics and dynamics classes. Like our stuff was more just like it's not moving, and y'all stuff like moves. So I found that's yeah, we have a similar background, I think, in that. And I know we've had this conversation too, because like the first time I met you, I was like, what was like your favorite engineering class, and what was like your most least desirable engineering class?
Wow, that is interesting. I think my least desirable engineering class was not necessarily my hardest. And I don't know if it's the same answer I gave you before, but I would have to say it was an electrical engineering class, because in mechanical engineering, and it's similar, I guess, across all of them, there are a couple of courses you have to take in some of the other engineering disciplines.
Yep.
And for me, I think the challenge with the electrical engineering is it's so conceptual and there's nothing that's tangible, nothing you can really physically see or touch. It just doesn't have any physical elements to it, right?
It's just like existing out there somewhere, and it all makes sense.
Exactly right. Exactly right. You're drawing diagrams, and you're talking about electricity flow, and you're talking about amperage and voltage, and it's just everything is invisible, right? And it's like you're just working on this conceptual stuff. So I don't know if it was maybe my least favorite class, but it was just I couldn't see myself going into the field of electrical engineering for all those reasons right there. I felt like I was more of a hands-on person, so I always kind of gravitated toward things that were just more tangible in that regard. I think my favorite course was going to probably be in the mechanical engineering area, and I would have to say, right, that helps, right? I would have to say it was probably Machine Design 3. I think that course is either that course or maybe Dynamics, and Dynamics was much more difficult, but I think it started having all the concepts come together at that point, right? Gotcha. All the prior courses are just focusing on just certain specific areas, right? And then when you start getting to the high level courses of dynamics and maybe kinematics was the Machine Design 3 course, things started kind of coming together, and you started understanding how it all worked and how it all aligned, and you started seeing more complete systems instead of just individual component type concepts.
Right,
so,
right.
Yeah, I think at that point it started kind of making more sense to me.
Yeah, I would definitely agree with you on the circuits. Like, I was an electrical engineer for 3 years. I took all the coding, all the computer classes, all the coding classes. I was great. Well, I was good enough. So, and then I got to circuits, and they said the current goes this way, but something else goes the other way. And I was like, nah, this is it. It's just. I got to the midterm. I made it as far enough to the midterm, and I think I got something in the teens, and I was like, I don't think I'm gonna be able to be an electrical engineer. So I switched, and I switched to civil. And my favorite class was structures.
Okay.
Which I think is what all civil engineers like, is they like building buildings, you know. And then you realize to be a structural engineer, you got to get a master's degree, and then you really want like a PhD to be a structural engineer. You know, if you design buildings, you know, you're on the 20th floor, you would hope whoever that engineer is, he was an expert at what he was doing. And I realized, man, I don't want to do that. So I was an engineering degree, and that was it.
I tell you what, though, there were two. So we had to take 2 civil engineering courses as a mechanical engineer. And these were 2 of the toughest courses, even throughout mechanical engineering, these 2 civil engineering courses.
Gotcha. I thought you were going to say these were the easiest classes.
No.
Here we go.
No way. In fact, it was a lot of times for mechanical engineers, these 2 civil engineering courses ended their mechanical engineering degree career.
Oh, is that right?
Yes. The first one was statics.
What?
I know. I don't know if it was just the way they taught it, but it was, I guess, and you took that course before you got far along enough in the engineering curriculum to kind of understand just kind of the way of the world and how to, you know, navigate your way through these courses, and really how the professors are looking to, you know.
They're weed out classes. All engineering classes are weed out classes, in my opinion.
Yes. And then the second civil engineering course was mechanics of solids, I think it was. In fact, at LSU, it was a civil engineering course. I've also heard in other universities, sometimes it's a mechanical course, sometimes it's a civil course, but at LSU, it was a civil course, and that was tough too.
Yes, I remember mechanics of solids, but I don't remember mechanics of solids.
Yeah, I hear you.
You know what I mean? I haven't used that class not once, but anyway, so enough on the engineering. So how did you first hear about investing in real estate? What was the first thing that said, okay, maybe I should look into this a little bit more? Like, what was the first, like, okay, let me just kind of listen to this?
You know what? I have three separate and distinct stories about real estate investing and how I got into it. The first time, I never forget, I had just graduated from LSU. So I'm working for an oil and gas company and in Houston. I was actually in Texas City. I'm from New Orleans, and it must have been around the holidays. I was on a flight from Houston to New Orleans, and I'm sitting next to this guy on the plane. And at the time, this is about 20 years ago, this guy lived in Baton Rouge. But Baton Rouge was more so a small regional airport, much smaller than it is now. So he was also flying into New Orleans and was going to drive back. That guy's name was Ed Spilly. So Ed, if you're still out there, this is Ryan. We sat on the plane next to each other about 20-something years ago. And Ed, we got in a conversation. And the only thing I remember from the conversation is Ed Spilly said, I'm a real estate investor, and I'd be willing to share with you and show you the ropes on how to invest in real estate. And Ed and I never spoke again after that airplane ride. We never spoke again.
So you learned everything you needed to learn.
Right. Right.
He's like, got it, Ed, thanks.
Right. I think I called Ed one time, and I don't think he picked up, but we just never connected ever again. But I never forgot his name. I don't know why, but his name always stuck with me. Then if you fast forward 20 years after that, or maybe 15 or 20 years after that, this is in 2015. That happened probably in 1997, right? So you're talking about 18 years after that. I was visiting New Orleans with my family, and I'm driving back to Houston, and I'm probably 45 minutes away from my house. My wife is sleeping in the car, my kids in the backseat, they're sleeping, and my brother calls me. And my family calls me Ronnie. That's my nickname, is Ronnie. And he says, hey, Ronnie, I have a friend. She's a real estate investor. She just moved to Houston. She's trying to expand her network. And would you mind talking with her? You know, she also kind of deals a little bit with investment property, stuff like that. And I guess he could hear a little bit of hesitation in my voice. He says, hey, don't worry. I told her you're not interested and you won't buy anything. And I said, I'm glad you said that, because I'm not. I'm not buying anything.
I'm not interested in being solicited.
Right. We'll just talk. Because at the time, Junior, I tell you what, I was very focused on eliminating debt. That was my main focus. That's kind of all I had really been exposed to and knew at the time. So I didn't have any car notes. We had 2 vehicles, no car notes. We had eliminated student loans. All we had no credit card debt. All we had was our mortgage. And I was just about to start into the next month to aggressively paying down a mortgage. This was in May of 2015, by the way. So her name, the real estate agent's name was Rachel Allen, and we still work with each other today. We're still friends today. But I decided to have a conversation. Rachel must have called me 5 minutes after I got off the phone with my brother, and we agreed to meet. And our first meeting changed my mind. We met at Beck's Prime. I never forget this. Beck's Prime in Sugarland, right off a highway station at 59. And we had just a casual conversation about it. She explained that she dibble-dabbled in real estate and from an investment perspective. And it was a real comfortable conversation. It wasn't pushy. And I think that kind of let me have my guard down. I came out of Beck's Prime in that meeting, and I told Rachel, and I told my wife, I said, that's it. I'm buying 10 homes. Right after that meeting, I'm buying 10 homes, which is ironic because I currently have 10 single family properties. Right?
Gold check. Yep.
So check that off, right? So that was
I think the other thing about that is, like, engineers, like, we don't like being sold anything. Like, just lay out the information, and we'll ask you 1,000 questions, and if it makes sense, we'll come back to you.
Right.
We will come back to you.
Exactly right. Exactly. In fact, I even mentioned that to Rachel. I said, what sold me on real estate investing was the fact that she didn't try to sell me on real estate investing. And right, just to your point. And so
imagine that.
Right? Exactly right. To just kind of relax in that environment and truly listen and understand and ask my questions and make the decision for myself. And that really helped. So that conversation and that meeting, that kind of initiated my action into real estate. So that was kind of the second one. First was Ed Spilly, just kind of planted the seed, but I didn't take any action. And I really didn't think twice about it after that. It was that conversation with Rachel that really sparked the interest in the desire to enter into real estate. The third and separate, I guess, incident, for lack of a better word, was a guy at work learned I was investing in real estate. And he would just mention things to me. He would say things like, yeah, you know, I know this guy, and he invests in real estate, and he does multifamily, and you can invest too, and it's all passive. It's all passive. And I'm like, what are you talking about? Right? Because these single family homes, there's nothing passive about it. Right? And I'm working with a property management company, and it's still not passive. You know? So I'm thinking, my goodness. And he kept saying that, and I didn't really think much of it. And then one day he says, hey, would you like me to introduce you to this individual? I said, hey, you know what? Why not? Sure, right? You never know. Yeah. So he sends an email introduction, and it was with an individual that you know, Junior's named Juan Vargas. Mm-hmm. And this was like in perhaps, I think it was like May of this year, 2019. And he introduced us via email. I got on, I immediately went to Google, right? I'm even at the office. I'm like, who is this Juan Vargas guy? Right? And I see all the information about apartment complex investing and multifamily syndications and things like this. And Juan and I had a conversation. He explained this much to me, but I only understood that much at the time. And, you know, we get on the phone and we're talking, and eventually we wound up having a meeting at Starbucks. But ultimately what happened was, on Juan's website, he had a link to his podcast. And so I listened to Juan's podcast. The very first podcast for Juan that I listened to, his guest was with someone you also know. His name was Lewis Houston, right?
Yep.
Exactly right. So Lewis and I have a similar background and similar companies in the oil and gas industry. And I listened to Lewis's story, got a better feel for, you know, what commercial and multifamily investing entailed and what the benefits were. And it just seemed like that was the direction I needed to go. I realized I needed to pivot from single family and go to multifamily to reach the goals that I have from a financial perspective.
Yeah, see, the advantage that Lewis has is that he's done it all. And he's done it for 10 years. He knows the rights, the wrongs, the ups, the downs. He just has this vast experience. I think he's in 20 deals, over 4,400 doors or something like that. It's like, it's just an incredible, incredible resume. So, but yeah, Lewis Houston and I were general partners on the deal that I mentioned earlier. So yeah, he's consistently just dropping knowledge.
Yes.
You know, on a weekly, whenever I talk to him, he always gives me a nugget that I didn't have before. Do you think that like your engineering background helped you, you know, analyze real estate deals, help you in any kind of way just to kind of make that transition?
Yes, definitely. And you mentioned this earlier, Junior. So I think engineers, we're all around numbers, right? Everything we do has some type of numbers behind it. And so I think it's, and complex numbers, right? Complex numbers, complex equations. So I think it's easier for engineers to quickly understand the financial aspects of real estate and how to evaluate deals and how do the numbers work. And we're quickly able to make sense of it. I think probably pretty easy. So I think the engineering background definitely does help.
Yeah, it was funny, man. 2 years ago, actually 2 years ago, this month, I graduated with my MBA, you know, with a focus in real estate as I was transitioning out of engineering into the real estate world. And I interviewed for like a financial analyst role with a capital markets firm, which basically helps you get mortgages. And I interviewed with this company, and they're like, you know, I like your background, the engineering, the MBA, but you have no underwriting experience. You have no financial analyst or financial analysis experience. So we're going to start you at an associate's role. And I was like, well, how much do they make? And like, what's that role entail? Because I know what I'm making as an engineer. And if I'm going to transition, like, what type of step back am I going to take? And I was just sitting there. And once I realized, like, okay, I'm not interested in this role at all, I said, well, what experience did you have to be a financial analysis? And they're like, yeah, you got to have, you know, experience with numbers and math and da, da, da. I was like, well, I had calculus 1, calculus 2, calculus 3, engineering math, you know, differential equations, steel design, concrete design, foundation design. I was like, So you're going to tell me I'm not qualified for this job based on numbers? I was like, based on math? I'm a licensed engineer. Like, if there is anything that I was good at, it would be the math. Like, and you're going to give me the spreadsheet?
Right.
Put the numbers in? I was like, I don't understand how I'm not qualified for this job. But anyway,
interesting.
Didn't turn down that job, went a different direction. So you mentioned earlier your first conversation was basically in 1997 or 1999.
Yeah.
Where would you be if you would have invested? I mean, that's two downturns ago. Like, where do you think you would be right now if you'd invested 20 years ago?
You know what, Junior? That's an excellent question, and it's also a little bit of a personally frustrating question, right? Because I asked myself that, and from what I know now, had I started 20 years ago, I would have more ownership of my time, put it that way, right? I probably wouldn't be in corporate America. Not that it's a bad place to be, but I think everyone's ultimate goal is to control their own time. And I think had I started in real estate 20 years ago, I would be much better financially positioned to right my own ship, right? And live the life that I want according to my own hopes and dreams.
You'd be Lewis Houston times 2.
There you go, right?
You'd be Lewis times 2.
Imagine that.
I probably wouldn't even know you.
Oh man.
So when we get, okay, so you've made up your mind, you're gonna be a real estate investor. You said you met Juan in May, and now you've invested in 1,100 doors, right? Passively. What do you look for when you're looking at a deal? Like, what do you look for in the underwriting? What do you look for in the submarket? What do you look for in the team? Obviously, the team's very important. Just kind of what are the things you look for when you're like, okay, I like this deal, and I'm gonna put, my money, my family's money, when you're gonna, make that financial decision to invest in someone's deal.
You know what's so interesting is that when we talk about real estate investing and we talk about the numbers and we talk about analyzing deals, I think there's one factor that has nothing to do with the numbers and nothing to do with the money that I look for before I get into any deal. And that's who the syndicator is. That's who the general partner is. Mm-hmm. And I look at that type of person. Hey, what kind of individual are they? What's their personality like? What are their thoughts and goals around investing in real estate? Where's their focus? Or, do we have an alignment of goals, an alignment of interest? Are they trustworthy? And sometimes you'll never know all the differences and nuances about that individual, but a lot of it is a little bit of a feel thing, right? An energy thing around how you perceive that person to be. And for me, that's the number one criteria, right? Can I trust that individual? Is that an individual I want to align myself with? Do I want to be around that person? Because like you mentioned earlier, it is like a little bit of a team sport. And so there's a part of it that, yes, it is about the numbers, but for me, I like the numbers and I want them to work and they have to work, but there's also an element of a community, right?
Yes.
And so that's the first thing I look at in a deal is who is that individual leading the deal? Who's the general partner? And do I feel comfortable and want to not only spend my money, but even spend my time with that individual? Yeah. And that's the first criteria I look for. So that's number one is the individual. And then comes the numbers, right? So after the individual, then it's around, okay, what are the returns? And do the returns help me reach my goals, or do they bring me closer to my goals, right? And so there are certain things I look for. Like my initial threshold in my mind, I always have, I call it like an 880 deal, right? 8% annual cash on cash return, 80% overall return. So not that every deal is going to meet that, but that's just my initial mental model of, hey, an 880 deal pretty much can help me achieve my goals, give or take, right?
Yep.
So I'll look at what is the return. So now I have the individual or the team, and then I have, okay, what are the projected returns? And then everything else from there is around what is their business plan and what do the numbers look like that give me confidence that they're going to make that projection, right? It's all about, hey, how have they developed this business plan and analyzed this deal to give me the confidence that they're going to meet that projection? So after the individual, after the returns, it's around what gives you the confidence that we can meet that. So the first thing, and it's quick high level things, right? Because again, time is always of the essence. So you can't be spending, 25 hours looking at a deal, for me at least. And so I think one of the things I look at pretty quickly is the cap rates. One, I look at the purchase cap rate,
Yep.
and I look at the reversion cap rate, right?
Yep.
And I feel like I want to make sure that the numbers in the deal are conservative and account for those unknowns, right, that may happen in the market in life. So I look for the reversion cap rate to be at least 1 percentage point or more higher than the purchase cap rate. And the higher it is over the purchase cap rate, the better for me, or the more comfort and confidence it gives me about the ability of that deal to meet its projections.
Right. Yeah. So just so a cap rate, folks that are maybe the first timers. So a cap rate is basically the way that multifamily, in this case, properties are valued, is the net operating income, which is the operating income subtracting out the operating expenses gets you the net operating income, basically everything before debt service. And then you would divide that by a cap rate, which is kind of determined by the market, and that would give you the value. So if the net operating income was $100,000 and the cap rate was 10%, it's 100,000 divided by 10%, that'd be $1 million property. And what Ron is saying is 5 years from now, as most of these analyses are done over 5 years, 5 years from now, say the NOI goes up, let's say it goes up 20%, so it goes up to 120,000. He would want the exit cap rate to be 11%, which is actually being more conservative, because when you divide 120 by 11%, and I can't do that math in my head, but I will do it very quickly. That would mean you would sell the property for $1 million, basically $1.1 million, basically. So by the cap rate being higher than what was purchased at, you're actually being more conservative. Hopefully, you would think 5 years from now, the cap rate would be at the same. Ideally, the market supports it, the cap rate would be lower. And so, your value at the exit will actually be even higher. So that's what a lot of syndicators do. They should put their exit cap higher, because 5 years from now, like you said, we don't know what's going on with the market on a macro level. You don't know what's going on with interest rates. Right now, interest rates are at historic lows, and if interest rates go up, cap rates are going to have to go up with it. That's just kind of how it works. So those are two things that you definitely look at. What's the business plan? How tangible is the business plan? And then, the cap rates. I mean, the cap rates, if you put a low exit cap, your whole deal could just completely turn around, and the numbers could magically work, where you're probably, you might be, the opposite of conservative. You might be very aggressive with your underwriting. One of my business school professors said, Excel is not one of the variables in underwriting a deal. So you can put any numbers you want into a deal, and you can make any deal look great. But one of the things that we do is we have, CoStar data, and we have apartment data, and we have economic data to back up like why we think, we'll be able to get these rents, or why we think the cap rate will be this, 4 or 5 years from now. So those are two very good things to look into. So you mentioned you have a spouse, you have kids. Like, what was that first conversation? You go to Kimberly and you're like, hey, like, we saved up all this money, or you have money in 401k, and you're like, I want to take money from that and I'm gonna put it in. First, you started buying houses, and then I should ask why what made you transition from houses into multifamily. But what was that first conversation like? Hey, we're gonna go buy houses first, and then what was the conversation when you went to transition to multifamily?
Yeah, it's interesting. I think the first conversation with Kim, I think I've always had a goal to live life on my own terms, right? And so having that financial independence, that financial freedom, was something we talked about, and that's what initiated the whole single family home path. And so the conversation there was I wouldn't say relatively easy, but I think
Nice.
we both kind of understood that, real estate, I think is accountable for creating more millionaires than almost anything else, right? So I think both of us understanding that it wasn't that difficult of a conversation to at least start in single family homes. I think the hardest thing with single family homes was buying the first property and getting over the fear of what if I can't rent the property, right?
Yeah.
I think the fear of having to pay two mortgages was that's very real.
Yeah.
And
Been
so,
there. Yeah.
yeah, right.
Been
And so
there.
that was the interesting part. And once we bought the first property and we had some recent decent success with it in terms of finding tenants and having them stay for a while, that really helped us continue on the single family home path.
Yep.
I think, however, right, even with 10 single family homes, what we noticed is to reach our financial goals, the single family home route is just not fast enough, right? And it's just more difficult to scale. Now, I'm not saying it's impossible. There are numerous stories and numerous people that go the single family home route and they are just uber successful, all right? But for me, I would need over 50 properties or more to get to the income that I would like to get, right? So for every home, you're having to give blood, do a cardiogram, because you have W-2s, bank statements, pay stubs, credit reports, and that's for every single property, right? Unless you just buy it outright. So I mean, my goodness, it was just so painful, right? And it would even make you feel bad. It's like, what do you think you're doing? You already have these properties. What another one that's just going to take you over the top? And are you sure you can do this? It's just
they're looking at your debt to income ratio, and they're like, man, it's all messed up. You're like, well, what do you mean? I have 8 properties already. They're like, yeah, we don't count those. They're like, well, what do you mean you don't count those?
Right,
That's a real thing.
Right, exactly. That's a real thing. I thought everyone said real estate is great, right?
Right.
And so for us, single family home, it was just too difficult to scale to get to where we needed. And it was going to take too long, right?
Yeah.
Longer than I'm willing to wait to reach those goals.
Yep.
And so having a better understanding of the commercial real estate, specifically multifamily and the returns there, it was a little bit easier to pivot for us, having to kind of go through some of the challenges associated with single family homes.
Yeah.
Yeah.
Yeah. So we got up to 3 single family properties, and I was like, what is the end goal? My similar goal to you guys, it was like, I'm gonna have 10 houses. But even when I did the numbers on the 3 that I had, even if I had got to 10, I still wasn't gonna be like where I wanted to be. So I'm like, okay, well, now I'm gonna have to get to like 100 houses.
Right.
Like, how long is it gonna take me to save up, 20 to 25% for a down payment? And then the other thing that happened on my single, like, stuff would go wrong.
Mm-hmm.
I had to replace a furnace on my first single family house. Like, the first year I owned it, the tenant called me like the eve of Christmas Eve. So it's like December 23rd. She's like, hey, Junius, there's no heat in the house. And this is like on a Friday. I'm like, okay, well, I'll be on the way. So I drive over there. It's like 7 o'clock at night. I'm like, yep, okay, turn stuff on. I'm like, yeah, the heat don't work. Call the AC company over, and they're like, yeah, that'll be $3,600. And, I'm looking at the tenant, and she's looking at the repairman, and she's looking at me. I'm like, well, then I guess we'll do the $3,600 right now, even though I was only going to make $300 a month. So over 12 months, that was 36. Like, I'm not making any money the first year. I'm not making any money, right? Kind of helped me on my taxes, but the goal was to make money. So had other little situations like that where it was like, man, I gotta replace this, replace that. Had a tenant like you talked about, like a tenant move out, and it's like, okay, well, I'm stroking the check for the mortgage for however long it takes me to fix up the property, because typically they just don't leave it in the greatest of shape. That's just a part of the business. So you're spending $2,000 to, maybe you upgrade some stuff in the kitchen or in the bathrooms. You redo the carpet, because carpet typically gets trashed. And then every month, that could take you a month to get a contractor to get in there and fix everything up. Then it takes you another month to lease it out, and then they don't start paying till like that could be 3 months. And you're paying the mortgage, you're paying the interest, you're paying taxes, and it starts to become a little bit of a financial strain. You're for me, it was like I would leave work where I'm very well compensated to go to the property to meet a prospect, to show them the property, and then they don't even show up. And so I just race across town. They don't show up. I'm racing back to work, or I set up a time to meet them on the weekend. I get there 8 o'clock, 10 o'clock, 12 o'clock. I'm calling them, emailing them, texting them, no reply. I'm like, man, I spent my whole day, and I'm gonna have to do it another weekend because I didn't have anybody. Nobody showed up, so I have to get the property rented. So totally understand the single family struggle or the hustle. Obviously, it's still a lot of people that do it that are very successful. Like you said, I didn't think I could scale the way I could scale by investing in multifamily, mostly because multifamily has economies of scale. It already has staff. It has repairs and maintenance that are in the operating budget. So like every month, hey, you're gonna pay, like it's budgeted to have a make readies. It's budgeted to fix little things in there, throughout the course of the year, and you still hit your returns. You still hit, the money you're gonna make. So for me, I just transitioned into multifamily. End up selling all of my single family houses over the last year and a half or so. So yeah, I understand those headaches.
Definitely. And I'm thinking about divesting some of my single family homes as well.
Yeah.
For the same reasons, right? I've had some similar horror stories that you're talking about. And in fact, you talk about that vacancy, and that's one thing I like about the multifamily is that, and one of the things I look at, right? So I'm looking at in the deal, I like to see at least a 10% forecast on economic vacancy. And I think vacancy in commercial real estate is less of an issue. And now it can become an issue, but at least with single family homes, if you don't have a tenant, you're 0% occupied. That's just it, right? Whereas you have a little bit of room, and like you said, that economic vacancy is included in part of the analysis where you can still make money and be profitable, even when you have a little bit of a vacancy. So absolutely, it's a real situation. It's a real thing.
Yep. Yeah. There's nothing worse. You get that. I remember I sent a renewal notice to one of my tenants, and she was like, "Oh, I'm moving out. Like, I'm out of here in 30 days. I mailed it to you. I mailed you my notice." And I was like, my heart just sank. Like, oh, I had planned on you renewing.
My
I have to go in, I have to fix some stuff up, and then release it to someone else that I don't know. And oh my gosh, she was like she was one of my best tenants.
Wow.
So any advice you would have for people getting into it for the first time, people that they're just watching this and they're like, okay, well maybe I should look into this a little bit more.
Yeah, I think my advice would be, one is to watch and listen to something like this, right? This webinar, this podcast that you're providing, I think is adding a lot of value, because at a minimum, you're exposing people to this particular asset class and just real estate investing in general. And so that's key. And I would say to continue to seek out other podcasts. I mean, that's what kind of prompted me into the whole commercial space was a podcast, right? Yep. And I think another big thing would be listen to the webinar, listen to podcasts, because one, it helps you to learn and educate yourself. And then I would recommend that people perhaps join a local meetup group, right? So I go to Junior's, we see each other at a local meetup group in the Houston area.
Yesterday.
That's right, exactly right. I said yesterday. So I think that's an excellent way to network and learn more about who's in the asset class, who's in the industry, and continuing to educate yourself on commercial real estate investing. So I would say definitely that would be two ways to get into it, is to educate yourself, podcast, and to network and go to meetups. And I think also is to just start, right? I think, as we have a little bit of a slant toward engineers here, I think sometimes things in life are they could be a blessing and a curse. So engineers, we're really good at numbers and we know how to analyze. But I think sometimes we overanalyze and we get into that analysis paralysis, right?
Yep.
So I would say also in terms of educating yourself and kind of exposing yourself to other people and information, I would kind of urge you to also act upon it, get into a deal, and not necessarily feel you have to wait until you 100% understand everything, because it's a journey, right? You never know everything. You're always learning. And I remember jumping into my first deal, probably knowing 50% of what I probably should have known at the time. But it accelerated for me the learning, and then it exposed you to more people, and you start learning you start learning what questions to ask, right? At times, until you get into it, you're not even sure what you should be asking, much less what you should be knowing.
Yeah,
right?
You don't know what you don't know.
Exactly right. You don't know what you don't know, even when you think you know it. It's not until I think you do it, and then you start really understanding what's really behind the numbers, and how does this whole asset class play out.
Yep, gotcha. Cool. So my final question, what does financial independence look like to you and Kim?
Excellent question. And ultimately, I have two answers. I think ultimately financial independence, kind of like we talked about before in terms of how you analyze a deal, it's all about the numbers, but numbers is not the first thing that you look at, right? It's about who that general partner is, who the sponsor is, who the lead is. And so it's a non-number metric or non-number thing that you're analyzing before you even get to the numbers. Similarly with financial independence, financial freedom, I think those are tied to your time. So it means financial freedom, financial independence is all about your time and being able to control your time. I think we talk about it in terms of money, but it's about time. And so I'm going to define it two ways. One is a financial independence. And the way I define financial independence, of course, is having enough passive income that covers all of your living expenses. That's one definition. And of course, that gives you your time as well. But then I'm going to throw in another term called financial freedom. And I have a little bit of a distinction between financial independence and financial freedom. So the independence is, again, around meeting your monthly living expenses, where financial freedom for me is not only meeting those monthly living expenses, but also having enough passive income to meet those expenses and your desired lifestyle, right? So now, in addition to those monthly living expenses, I might want to travel more. I might want to do more philanthropy. I might want to offer scholarships to people. So I'm going to need now money to do that. And so I think the first step for us is reaching the financial independence stage, right? That kind of gives you that security, right? And say, okay, that's right. Take it in levels. And if all else fails, you're at least financially able to maintain yourself.
Right.
And then it's about reaching that financial freedom where I now have enough passive income to go beyond my minimum monthly expenses and really utilize my time to enjoy life to the fullest and to what my desired lifestyle is.
Gotcha. Wow. Yeah, I totally understand what you're talking about. Just being able to kind of get out of the rat race and then just like really excel and live where you want, how you want, where you want, who you want, when you want, all those different things. That's like the mountaintop.
Right.
So this was as fun as I thought it was going to be.
Likewise.
I hope people that view this enjoyed it as much as I think we did making it. I think we're coming up on 30 minutes, so I don't want to be too much longer than that. But just thanks for joining us. Thanks for joining me. You were the first guest because you were like the initial. I was like, man, if I put this together, I'll definitely have a Ron, because all of our conversations kind of pointed me like, man, maybe we should do something. Real estate investors, that are engineers that are maybe transitioning out of engineering, or maybe they continue to work just like you do. But I wanted to do something like this for people like, that do the same things that we do. And just thanks for joining us.
Thank you so much, Junius. I am honored to be your first guest. I really mean that. And I'm sure, I think it's a great thing that you're doing to help provide exposure to engineers and other people who are interested in real estate investing out there. I think this is an excellent platform. Thanks for having me. And like you mentioned, hopefully people will find value.
Absolutely. All right, man. Appreciate it.
Thank you, Juniors.
All right.